It's go time. Hey, good evening, everybody. 7 p.m. right here in the Treehouse. We're getting ready to rock and dock tonight. We're talking about credit. One of my favorite discussions. It is one of the four main parts of a mortgage. You got your income, you got your assets, you got the house, and then you got the credit. So we're going to talk about credit tonight, and it's going to be a fun 101. We're going to talk about credit and then some benchmarks as far as, a lot of folks think that they have to sit on the sidelines because they have a preconceived notion that they don't have a good enough credit score, or they had a major derogatory or an event such as a bankruptcy or foreclosure that's keeping them out of the game. So we're going to jump into that tonight and here in the Treehouse, and we're going to talk about the good old credit. So without further ado, let's jump right into it. Credit is, like I said, one of the four major factors in a mortgage. And I hear this so much right here. I don't have good enough credit for a mortgage. I'm not going to buy a house. I'm not going to do it. I don't have good enough credit to refinance out of the current situation that I'm in and getting maybe a better rate, doing a cash out refinance. So let's dive deep into this. This is a myth, my friends. It's a myth. And credit, poor credit, 580. That's an interesting thing. A lot of folks sit on the sidelines thinking, "Wow, that's not where it's at." But here we have the whole credit band down to 300 up to 850, and everywhere in between, each stop in between. And how do we get to this credit report? How do we get to this credit score? Right? A lot of people, they know of these three brands: Equifax, TransUnion, and Experian, but they don't know what's going into it. So we're going to dive deep into that. If you don't know, and you're just starting off your career as far as maybe buying a house or getting credit cards, car loans, what have you, there are three credit repositories in the United States of America. They are Equifax, TransUnion, and Experian. And basically, each one of those three different credit reporting companies takes all the data that your banks, your credit card companies, your mortgage companies, your auto loan companies, and they take all that data, student loan companies, that's becoming a huge one right now. They take your payment history. They say, okay, great. John Smith opened up his credit card in 2000, and he's made every single payment since 2000 for the last 21 years on time, out the door. Awesome. Great credit, right? Or John Smith's had a credit card since 2020, and he's made only 2 of his payments on time, and he's got 10 missed payments. Not so good credit, right? So that's what these three different companies come together with, and they each independently work in their own right, but they have the same general output, right? The output that they provide you and me is this mythical unicorn number called a credit score, right? And each one's a little bit different. Equifax could have the same exact data set as TransUnion, and Equifax score may be higher or lower than TransUnion, and vice versa. And everybody asks me when we go through the mortgage application and we review the credit, they're like, so I don't get this. Tell me, why is Equifax at a 662 and TransUnion's over here at 710, right? I can't get too deep into that, but I'll tell you kind of how that works. Couple things. 2 things are the main drivers here. Equifax and TransUnion come to the conclusion of what your credit score should be in different ways, right? They have different algorithms in their makeup. The other thing is sometimes a credit card that you have, a car loan. I see this a lot in credit cards, and I see this in car loans. Sometimes they won't report to all 3 credit bureaus, right? So maybe you've got a car loan that's only showing up under Equifax, and it's not showing up under TransUnion. And maybe you had a late payment. Let's call it a 30-day late on that car loan that's over here in Equifax, And then Equifax is taking that into account in coming up with your score. TransUnion, not so much, right? So that is really the number one driver that I see is sometimes all your accounts aren't getting to each credit reporting company. It's not necessarily mandated for a creditor to send it out to each individual reporting company. And here's where it gets really sticky. If you ever have a collection, if you look at the collections on your credit report, I highly doubt that they were reported to all three bureaus. They were probably only reported to one, maybe two, right? So when you're looking at Equifax and TransUnion, they're solid, but all of a sudden Experian score is way different, way lower. Maybe there's a collection, right, from a utility company or a medical collection or what have you. So, that's just the high level what these three companies are doing. So why is credit important? Credit is important because credit has been interwoven into our lives now, right? Credit back in the day used to be to validate whether or not you could get credit, right? But now it's not just lending, it's in insurance. There's insurance-based credit scores. Employers look at your credit score. If you want to go rent a house, you got to get your credit pulled, and then you have to meet their credit requirements and guidelines, and so on and so on. So credit is important, guys. It's a really important topic that I talk to all my clients about. Healthy credit habits, making sure that we're paying on time, making sure that we have credit utilization at low numbers. It's important not just from the lending perspective, right? It's important in our life across the board, in jobs, rent, insurance, and many other facets of our life, that it's just been over the last, really, I think, I started in mortgage in 1999, and credit was very much just lending based. If you needed something from a lender, credit was definitely right there, hand in hand with that situation. As we progressed through the last 2 decades, credit has woven itself right through everything else in our lives. So make sure that you keep that credit in good standing. So, okay, great. Got some good credit, or maybe I don't have some great credit. Let's talk about the minimum standards that we care about on the lending side, that maybe you've been sitting on the couch saying, no, I can't, my credit sucks. I can't do it. I'm not going to get a mortgage. So does anybody want to take a guess out there in La La Land? What is the minimum credit score that you could get a mortgage on? It's a 580. 580. FHA and VA will allow credit scores to go down as low as 580 and up, right? So a lot of folks out there, because I've seen the headlines, guys. You've seen the headlines too. Headlines say, oh, the average credit score for homeowners is X. Average credit score for homeowners is Y. If you're going to get a refinance mortgage, you need this credit score. Those are just buzzwords. Talk to a mortgage professional. Sit down with me. Let me look at your credit. And here's what I guarantee that we do for every single one of our clients is, if you don't meet that 580 credit score, if you have a blemish on your credit report, guess what? Take the action, and we're going to help you take that action with our credit repair partners. So just because you have maybe what you think is not qualifiable credit, you'll be surprised. So let's talk about the other big underwriters. When we talk about the other big underwriters, we talk about Fannie Mae and Freddie Mac. Conventional lending. Conventional lending will go down to a 620 score. And then if you're looking in the jumbo market, the jumbo market is anything over a $776,000 loan amount here in the greater Seattle area, the Tri-County area. So if you get north of that, you need to have a 660 credit score and up. So for all you out there watching this right now, if you thought your credit was holding you back, make an application. Worst case scenario that we can put you in is the fact that we're going to refer you out to our credit repair partners, and you're going to have a plan of action to get into a house. That is powerful. It may not be right now. It will be sometime in the future. in the mortgage industry, we're supposed to stay away from things like everybody can qualify for a loan, everybody can do this. You know, if you take the proper due diligence and put together your plan of action to buy a house, there's nothing stopping you. You just have to jump in and be fearless. So that's that. Let's talk about the other thing that keeps people on the couch saying, no, I can't do this. I've seen less and less of this as we've gotten further and further away from the mortgage meltdown. But the other thing that people just self-eliminate with and say, hey, I can't go buy a house, is because I've had a bankruptcy. I've had a foreclosure. I can't do it. It's not a deal killer. It's not a deal killer. Just the fact that you've had a bankruptcy, a Chapter 7, a Chapter 13, you've had a foreclosure. That's not the deal killer, right? We just have to have seasoning from the time of the event. You know, so conventional, typically we want 2 to 7 years from the time of the event. In FHA land, it's 2 years. In jumbo, it's 7 to 10, right? The most restrictive definitely is the jumbo market. But for those of you that have gone through, here's a lot of the scenarios that I see now is people have gone through a scenario. Maybe they've been divorced. Maybe they've gone through the mortgage meltdown and they had that bankruptcy and they just said, no, I'm just gonna rent the rest of my life. I can't do it. Foreclosures, bankruptcies. I'm no good. I need to wait till it's 10 years off my record, right? It's just not true. So again, have that conversation. Let us see your credit score. Let us give you that guidance to, if it's not now, when can you buy, right? It's not that's really the question that we want to answer for you is, if not now, when? And that's where the power lies. So those are the two biggest self-eliminators, the minimum credit score. So we'll pop back there, and then the major derogatory events, right? So I alluded to this a little earlier, so I wanted to dive a little bit deeper to it. How does FICO scores work, right? 99% of all the mortgage lenders out there, we use FICO score. So when we go to do that mortgage application, we're going to pull a tri-merge credit report. Tri-merge meaning all three of them, Equifax, TransUnion, and Experian. And this is how FICO's rating it. This is how it's coming down in the algorithm. So let's go through this really quick. I'm going to make this bigger. I know y'all like to see my face, but let's talk about this really quick. You know, so obviously credit score is very heavily weighted in two departments, right? The amounts that you owe, right? And your payment history. Obviously, payment history is the driving force. Actually over a third of your credit score is derived from your payment history, right? So that's looking at a blended history over the last 24 months. Then the amounts that you owe. Down here, 15% is the length of credit history. So a lot of folks come to me and say, hey, Keith, guess, great news. I went out, I got a brand new credit card and I'm going to bounce up my score. And all of a sudden they get their score back and their score fell, right? So maybe I've got one trade line, I've got one car payment, and it says, well, there's not a lot of credit here and we've got a lower score, and you go out and you get a credit card. Where you apply for a new trade line, whether that's a credit card, a car loan, any piece of credit that you're out there applying for, it's going to pull your score down because it's going to say, whoa, red flag, John's got a new trade line. Let's wait for 3-6 months and make sure that they can service the debt. So length of credit history is a huge one. So the longer you're in the game, I want to say this right. The longer you're in the game does not necessarily mean the better the credit score you have. The longer you have good payment history, low amounts owed, the better off you are. And then a lot of folks want to say, oh, I have to have a whole bunch of different types of credit. Types of credit, just merely a small 10%, as well as the new credit here is impacting at 10%. So that's how we derive our credit scores and the credit scores that we in the mortgage industry look at. And The reason this is important is a couple things. Number one, I definitely want you to feel empowered knowing how, number one, your credit score is derived. So as long as you know what's in the recipe, you can fix it, right? If we didn't know that payment history is part of the rating, well, oh yeah, if I get to pay that bill this month, great. If I don't, okay, we'll get to it next month, right? But now that we know how we are impacted about by the amounts owed on our credit cards, if we pay those down to a 30% threshold, let's say you got $1,000 credit card limit and you're right there at $1,000, you max that bad boy out, that's going to have a negative impact on your score. If we pay it down to a third of the balance, that's going to pop your score straight up through the roof. So it's always good to know how to navigate these waters that we call credit scores so you can improve and peak the scores. Because though you only need the 580 or the 620 to get in the door, the higher credit score you have, the better off you are with regard to rate. Short property type, there's only one other factor that really drives your rates. That's your credit. Your credit is the number one driving factor of your score, right? So now, this is why I started thinking about credit scores, because in this last few weeks, I've talked to a lot of people that are ready to get in the market and go buy their first house. And guess what? They shared this with me. Whoops, wrong screen. They shared this with me. Does anybody know what this is right here? This is the Credit Karma dashboard. Pretty cool, right? So this is Credit Karma. And I took this snippet because I wanted to show you something that's super, super important, right? Going back one slide, the mortgage industry uses FICO score, right? So credit scores are like, okay, Nicole, I'm going to steal this straight out of your presentation. Credit scores are like ketchup, right? So one of our preferred credit repair companies, Nicole, is the owner of it. Nicole says this: credit scores are like ketchup. There's a lot of different brands of ketchup, right? So the mortgage industry uses a ketchup called FICO, right? Guess what Credit Karma uses? Credit Karma uses, if I'm going to make this big for you guys, Credit Karma uses right down here your Vantage score. You guys see this down here at the bottom? I'm hovering my mouse over it down here. Vantage score. So the reason why I bring this up is because so often in the mortgage industry, folks come to us, they're getting ready to get pre-approved. They're getting ready to do that cash out refinance so they can add on a beautiful patio and outdoor dining area, or re-landscape their house, or put their kids through college, or you fill in the blank, right? Whatever you want to do with your refinance, the questions come up. Well, Keith, your credit score came back at 680 and my Credit Karma says I'm at 718. What's going on? And that, my friend, is the $1 million question that I wanted to definitely dive into in the Mortgage 101, right? We know who the players are, Equifax, TransUnion, and Experian. We know how they're coming up. But why is my Credit Karma different than what Keith pulled with my mortgage application? And here's the proof in the pudding, folks. The Vantage score and FICO score, they come to a different conclusion through different analytics, right? As we discussed and we looked at earlier, the FICO score is driving it about by amounts owed and by payment history, right? Over here, look at Vantage score. Payment history is only 32%, as opposed to 35%, right? And then credit utilization on Vantage is 23% of your score, while balances are only 15%. And over here, balances and amounts owed are 30% on FICO. And then, you guys see something? Depth of credit. Does that mean the same thing as length of credit? No, it doesn't. It just means depth of credit. How many different lines? There is a small element of how long they've been together, but how many different lines? So what I'm trying to say here is the magic sauce is a little bit different with FICO than it is with Vantage Score. So it's very important for you guys to understand this, that you could come to a mortgage lender, they pull a FICO score, but it's not what you're getting through your Credit Karma. It's not what you're getting through other credit reporting companies and what have you. So one other thing that I wanted to talk about really quick in the Credit Karma scenario, the other shocker for a lot of folks when we look at Credit Karma is, you guys notice something here on the screen? There's only two scores, but there's 3 reporting companies, right? So we got TransUnion representing, we got Equifax representing. Experian is not part of the Credit Karma world. So though you are seeing 2/3 of the credit reporting world in the scope of Vantage, you're not seeing the third piece too. So I'm just saying there's a lot of different things that can come in as far as variables. So keep that in mind when applying for mortgages and other credit things. So that really concludes tonight what I wanted to talk about. Make sure that you guys have the conversation. Give me a call, DM me, reach out, email me, go to my website. Let us know how we can help. And if you do think that maybe you're right on the cusp, maybe you can't afford it, maybe you can get through the credit underwriting, it never hurts to ask. It never hurts to make that application and see if it truly is possible. Because guess what? Worst case scenario is we put you on a path to buy. We hook you up with the right credit repair professionals to get you credit up and offer ready. So big key, pay on time, both of them. A third of your credit report is always pay on time, pay on time. And you don't need perfect credit to buy a house. So if there's anything that you guys take away from tonight's Mortgage from a Treehouse, that is the number one thing. You do not need perfect credit to buy a house, to refinance your house, to help help you execute those financial decisions. Make the application, make the call. We're here for you. We want to help you with that refinance or buying that house. So you do not need perfect credit to get into housing. Well, there we are. That was fast. That was furious. That's Credit 101. Looking forward to seeing you guys next week when we talk about the timeline of a purchase. And we're not just going to talk about the general timeline. We're going to talk about today's timeline and how crazy it is out there and what you have to do pre-offer, post-offer, during the offer, and then what the mortgage process looks like and when all the money's due. So I hope you found some great value tonight. If you have any questions, by all means, throw it in the chat. We'd love to answer those questions for you. And look forward to seeing you guys next week from Mortgage from a Treehouse when we jump into the timing of your new purchase application. Take care.